bears are extinct. Bears are now on the endangered species list. There is nobody bearish on pretty much anything. Here's a chart of the short interest on the S&P 500 and the NASDAQ. The short interest on the NASDAQ is at 6%. It's never been lower. You're only at about 10% short interest on S&P. That's also a very low level. So there's basically nobody bearish on the markets. Everybody's long. And Sam Sovall, who was head of S&P research for a very long time, he works for S&P Global. He once said that when everybody's bullish, there's nobody left to buy. Everybody's long. And this is one of the things that I've explained to you before about how markets work, and this is why it's so important to understand market dynamics, particularly when you're managing your own money, is that there's a relationship between buyers and sellers in the markets. Just like on Friday with silver, in the midst of that decline in silver, there were buyers all the way down because every time somebody sold, somebody had to buy it. There has to be a buyer for every seller. The question is always at what price? And there's a pyramid relationship in the markets between how buyers and sellers interact. As price is rising, sellers become more scarce. They're like, why am I going to sell my silver, my gold, my stocks, whatever it is, when it's going up? I don't want to be out of it because I don't want to miss upside, right? That's just our emotional nature of greed. However, there's a price where we'll all sell something, both up or down. So as prices are rising, buyers have to keep stepping in and going, I'm going to pay you more for this asset price because I want it. And the seller says, okay, great, I'll sell it to you, but it's going to cost you this much. And this is why you see things kind of gap up sometimes. And we saw this in precious metals just recently, where silver would be up 5 or 6 or 10% in a day. And that was because sellers were going, yeah, I'll sell it to you, but it's going to be 10% higher. And then that's how you get there. That's why you have these big gaps that open up in the markets. But as that occurs, you have fewer and fewer sellers that are doing that. More and more people are buying. The sellers that are willing to sell are demanding higher prices. So you've got this rush of buyers in to chase prices higher, but you have fewer sellers willing to sell, which is spiking these prices higher. So you get these big moves in markets, stocks, commodities, etc. This is what happens. However, the inverse also occurs. At some point, something happens that causes a reversal in that price. Now, all of a sudden, everybody that was unwilling to sell previously wants to sell all at once, and buyers are going, hey, I'll buy from you, but here's going to be the price lower. So as the prices fall, you get more and more sellers come into the markets. Buyers are becoming more scarce, so it works in reverse and it works against you. And this is how you have these very big declines that occur. You get a 5% down day in the markets like we saw in 2020. You get a 30% down day in silver like we saw on Friday. That's how that occurs. It's just that supply-demand imbalance working itself in the markets. And of course, you throw on leverage and margin calls and everything else, and things can get bad pretty quickly.
Catch me daily on The Real Investment Show. The link is in the description.